Hi everyone, welcome back to Be Rich. Yes, surprise, surprise, I'm in the studio today. This is not AI generated studio. This is the actual studio. I'm actually in the studio today because I've flown down to Chennai for just a few days because Anand needed me to do something here. So lo and behold, I'm in the studio and Rupesh is the happiest man I've seen in the studio today because he's happy to see my face in person. And he's like, thank God, I actually get good footage from a good camera and great audio and not something which I have to denoise 1,000 times and keep on stabilizing the footage, especially when I'm sitting in a car going like this. So he's very, very happy. And I'm happy to be back in the studio. Yes. I miss Chennai. It's been almost, what, Rupesh, 3 weeks since I was in the studio? Yeah, man. It's almost a month since I was in the studio. So I'm happy to be back in the studio. You can see the energy levels are much higher when I'm in the studio. Yes. So in the same light, I have something great and interesting to talk about, which you should definitely see. And if you have seen this and you think it's worth it, please go send it to some of your friends who are invested in American equities, are in the US. They should also definitely see this. This is not advice from me. It is advice from the great guru Warren Buffett himself. So that is why I'm saying keep an eye on this video. At the end of the video, I think you will agree with me. If you don't agree with me, comment. If you think Buffett is correct, comment. Those comments really help us understand what you understand and what you don't understand about what I'm saying. So I can work on the next episode and make it more in line with what you require. So what is Buffett saying? Well, Buffett has been piling on and cornering in the short-term bonds. The short-term bonds in the US, 5% of the bonds is now entirely cornered by him. Can you imagine the size of the short-term bond Treasury Bill market? And Buffett is sitting on 5% of it himself. That should definitely be a signal. Signal for what? That is the question. And what should you do with the signal? Of course, we look to Buffett because we are value investors. We're not traders. We're not bondsmen. We're not all those other flavors. Our flavor is pretty vanilla. We are value investors. We look at it long term. So whatever Buffett does, especially at this point in time, in this current situation, we should definitely pay attention to it. Because if anything, what has been proven is volatility is here to stay. It is the norm. There is no more security in thinking things are going to be the same. It is not going to be the same. What is said in the morning can change in the afternoon. By evening, we can go back to it, or we can have something new altogether. Especially between China and Trump, they seem to be determined to create further confusion in the market and muddy the water for us. By muddying this water, there is completely no kind of sense and direction on what we should do in terms of investing. Creates further confusion for us value investors, especially when we're trying to look at it long term. Yes, in the long term, things will be fine, yes. But like Charlie says, it's important to buy things at the right price. An equity market, especially in the US, are not looking at the right price because of the lack of clarity in what tariffs are going to do, what is going to happen to inflation, what is going to be happening with the Fed, all that. People in the US seem to be binging on equities is what Warren feels himself. That is why he's cornered 5% of the short-term bond market Treasury bills he's sitting on. So why? Because the bond market has been flashing warning signs. Anand has spoken about it in LinkedIn. I've spoken about it on some videos. And Anand has spoken about it in some discussions with Vishnu on the Tamil channel. So what are the flashing signs? The flashing sign is the world in entirety is starting to lose confidence in the American way they're governing themselves because of what Trump is doing. They seem to be taking this attitude that, hey, I'll do whatever I want. You can't do anything about it. Either put up or shut up, as they say. And the world doesn't seem to be very happy about this, and it is reflecting in the bond market. Where is it reflecting? If you look at it, like I said in a previous video, if you take their long-term Treasury bills, which are supposed to be the safest, most secure places to park your money, most big corporations and big sovereign investments, they all park it in long-term bonds, these 30-year Treasury bills, and there is where we have been seeing most volatility. If you see month to month and if you see 6-month periods, it has gone completely haywire. You see it going up, it's gone negative, then it goes positive. This is the same way Trump has been turning the switch on and off with tariffs. The bond market is seeming to become more and more volatile. And first, initially, he reacted, getting scared by what the bond vigilantes were doing, and he backed up. Then the bond market kind of cooled off. Now he's back at it again, and the bond has again become volatile again. So this is the main reason why no one is looking at the medium range treasury bills. They're not looking at the long-term treasury bills. All the money seems to be going to the short-term yield, and that is looking very unusually attractive. The 3-month T-bill is at 4.34, which is almost at the same point where 10-year T-bill is, which is at 4.4. But the point is, the 4.4 10-year T-bill is extremely volatile, while the 2-year is sitting at 3.9. So it gives you a very strong sense where all the money in the bond market is running towards. It's running towards the short-term 3-month T-bill. Even all the ETFs, the SGov ETF, the Bill ETF, they're all focusing on ultra short-term T-bills. Among the top 10 ETF inflows this year, SGov alone has taken in more money than any other ETF except the Vanguard S&P 500. So why not the long term? I told you the 20-year Treasury bill has flipped from a negative to a positive 5 times this year, which is considered extremely volatile. The performance has been negative since September, and this only happened the last time this kind of reaction we only saw in the bond market was in 2008 in the middle of the financial crisis. So it is hard to argue against short-term bonds. And even Buffett, if you don't believe anything what I've said, even Buffett's signal seems to be very clear on this. At the current moment, Berkshire Hathaway owns 5% of all short-term T-bills, and that is not a small move. That is a massive move, considering the size of the T-bill market in short term. If you see, Buffett is not trying to time the market. If anything, he's looking for safety, liquidity, and the optionality of a cash for future deals. So if he sees a future deal, market cracking and something terrible happening, and he sees amazing companies being thrown away, he has cash in his hands to buy it. So this is the main reason. But he is not touching the 30-year treasuries, and he's staying very nimble, and that is a huge signal that he's sending to the market. And we as value investors should definitely look at the bigger picture, because inflation, tariffs, and tax cuts, even the Fed, which started cutting interest rates 9 months ago, has suddenly paused. Why have they paused? The reason why they're pausing is because the tariffs are a big concern to them. Inflation risk is extremely real in the US thanks to this tariff, and this major tax cut which is pushing through, let alone what is all happening to the NRIs and our investments, and which I've discussed in the last 2 videos. If you look at the terms of the deficit which is going to be ballooning thanks to this tax bill, it's incredible. So all this is even giving the Fed something to be cautious about. The problem is, in the US, investors have been rushing towards equities, and they seem to be not having any appetite for bonds today, and that is what all analysts and investors and anyone who is worth a salt is trying to say, that we should all be diversifying and moving some of our positions into bonds, especially if you're sitting outside and in the American market. Bonds is something also you should have in your portfolio, and let's not sit on purely on equities. And if you're very much interested in equities, of course, like my brother says, Japan is a magnificent place for you to place your eyes on, because in the last 2 years, it's given 25% returns, and the last year on to date, that is year to date, it's given 10% returns. So if you are looking at equities, the Japanese equities are great, Japanese companies are great, especially when you look at where the currency is sitting against the dollar and all the other things which we have spoken about. And if you are in the US and you've been very keen on US equities, please do diversify a little bit and start looking at some short-term bonds in your portfolio too. That is the main essence of this video. So this is a takeaway which I wanted to give you. You cannot predict what the Fed is going to do. You cannot go on chasing the S&P 500 index. So sometimes you just have to listen to people like Warren Buffett and take his sage advice and park some money in bonds. I hope you found this video informative and entertaining as always. It was great to be back in the studio to record with Rupesh in the same room. for a change after 3 weeks. I hope you did enjoy it. If you did, like it, subscribe it, share it. Rupesh has told me I should do that in every video and not be sounding like one man who's nonchalant about everything. And he's told me to bring a lot more energy to the video, which I'm doing. And see you in the next one. And I shall not say good night, and I shall say good evening from now on, because Rupesh says, sir, don't say good night. It sounds very negative. So from now on, good evening to all of you. I'll see you again tomorrow from the studio again with another one. Thank you.